It's good to see such a big crowd after the cocktails last night. It's my distinct pleasure today to introduce Dr. Michael Stegman, who is the counselor to the Secretary of Treasury for Housing Finance Policy. Um, I can't say how excited I am. Dr. Stegman has been such an influential and key figure in housing for many years, and in his role serving the Secretary is going to be really instrumental in shaping housing finance reform and some of the things to come. Currently, he coordinates the Treasury Department's activities relating to the development of our nation's housing finance policy and also assists in the implementation of Treasury's housing programs. Many of you may recognize Dr. Stegman. Prior to joining the Treasury Department, Dr. Stegman served as the Director of Policy and Housing for the Program on Human and Community Development at Chicago's own MacArthur Foundation. He served as the foundation's leading observer of domestic policy issues. And before joining the foundation, he served as the McRae Professor of Public Policy, Planning, and Business at the University of North Carolina at Chapel Hill. There's actually a number of his students here today that have come to pay homage to Dr. Stegman. Currently, Dr. Stegman chairs a steering committee composed of senior Treasury participants and coordinates the Treasury's work with other agencies within the executive branch. We've worked really, it's more and more, we've worked so closely with the Treasury on housing policy. Everybody here is familiar with the low-income housing tax credit, which I've worked with the Treasury on for a long number of years. But Ida, in particular, has worked with the Treasury which has been a critical partner of the state in providing needed liquidity and resources to the market in response to the crash in '08. Through various Treasury stimulus programs, Ida was able to commit over $420 million in funds, which leveraged an additional $550 million in funds to over 75 developments across the state, creating 6,000 new units of affordable housing. And that was all through programs that were overseen by the Treasury. More recently, in partnership with the Treasury, my agency was able to launch the state's Hardest Hit program, which assists Illinois families in preventing foreclosures. And to date, we've committed $170 million to 7,300 families across the state, helping them to avoid foreclosure through that program. Yeah, it's a great program. It really has been just a tremendous program for the state and has really allowed us to really help some folks that were otherwise probably facing foreclosure. And we continue to help new families every day through that program at a rate of about 25 families a day. So it's just been an outstanding resource for our state and has really helped to stabilize a lot of communities, and we've been able to layer that on to our other foreclosure prevention efforts within the state. So Treasury has really been just a key and critical partner to the state in its affordable housing initiatives over the past 30 years, but really critical over the last 5 years. So it's my distinct pleasure actually to welcome a preeminent scholar and a great American, Dr. Michael Stegman.
Good morning, and thank you, Mary, and it's really great to be here with you on this wonderful spring day. It really is an honor for me, and by the way, it's really great to see so many students, but when you've been around as long as I have actually taught the children of some of the students that I've seen now, and at some point it's time to kind of hang it up. But it really is an honor for me to be with you today for a whole lot of reasons, and Mary suggested some of them. Chicago is one of my favorite cities, and so I was excited on my first really trip for Treasury to be here last year to witness firsthand how our homeownership preservation fairs are helping distressed borrowers save their homes through affordable loan modifications. And I'm pleased to say that we will be back again in Chicago here to host a similar event with loan servicers, counselors, and to help families on May 16th next month. Now, as Mary mentioned, prior to joining the Obama administration, I really had the privilege of working here in this great city for truly one of the world's greatest philanthropies, the MacArthur Foundation, where, as Mary said, I served as Director of Policy and Housing under the gifted leadership of Bob Gallucci and my boss, head of U.S. programs, Julie Stash, with my colleague Mio Vojdapich, who's here today. Many of you know Julie because of her lifelong commitment and support of affordable housing through the Foundation's direct housing investments, research, and policy initiatives. And to top it off, I couldn't be more pleased to be here because truly there are no public institutions, housing institutions more central to meeting our affordable housing challenges than state housing finance agencies. And in my view, there are none better than the Illinois Housing Development Authority, which has been guided by the terrific leadership of Mary Kenny. Well deserved. And there are a few statewide affordable housing networks in the country that are as impressive as the Illinois Housing Council, which is really so ably led by Andrea Trout, and I think she deserves a hand. So for me, it just doesn't get any better than this. Serving as a keynoter at an affordable housing conference co-sponsored by IDA and IHC and organized by a public servant with an unparalleled commitment to expanding housing opportunities for those most in need, Governor Pat Quinn. So thank you all very much for allowing me to share with you some of the important work we are doing in affordable housing at the Treasury. Given my role at Treasury as Housing Finance Counselor to Secretary Lieu, it's probably no surprise to hear that I meet frequently with a wide range of stakeholders from the world of housing, including researchers, market analysts, financial industry experts, investors, advocates, and legislative leaders and their staffs from both sides of the aisle. Taking the pulse and gaining insights from all of these players is an essential part of my job. In my 16 months at Treasury, I've met with state housing finance agency leaders on 5 separate occasions. And I can tell you with confidence that there will be more such engagements in the future, given the important role that organizations like IDA play in helping address the critical affordable housing challenges facing our country. For decades, HFAs have done this by providing 2.6 million families with access to low-cost mortgage credit to buy their first homes. And every year they provide an average of 27,000 borrowers with critical down payment and closing cost assistance. And through their allocation of low-income housing tax credits and issuance of private activity bonds, these essential organizations have helped finance the production of 2.9 million affordable rental units. Over the years, FHAs have matured and increased their value added, in my view, in 2 important ways. First, they've evolved in their thinking from thinking in purely project terms to setting priorities and using their resources to execute on locally developed, needs-sensitive affordable housing strategies. And second, and equally importantly, in order to achieve better outcomes, leading HFAs like IDA have deepened their financial and capital markets expertise, increased their investor base, enhanced their loan and asset management capabilities, and expanded their relationships with originators, investors, mortgage servicers, housing counseling agencies, and affordable housing organizations throughout their respective jurisdictions. Since 1967, through the issuance of tax-exempt mortgage revenue bonds, IDA has helped finance the production of approximately 225,000 units of low and moderate income rental housing, amounting to more than 7% of the state's total rental inventory. And in 2012, IDA provided more than 2,700 Illinois families with critical down payment and closing cost assistance to help them purchase their first homes. And additionally, IDA has shown us that innovation can flourish in the public sector. Through its Preservation Now program, IDA provides subordinate mortgage financing to tax-exempt bond projects that have an existing project-based rental subsidy if the owner agrees to continue that in the rental housing subsidy program. It's about expiring use and extending the affordable life of these developments. This novel approach has helped preserve critical affordable housing resources for the citizens of Illinois, 2,900 units in 2012 alone. So IDA and counterparts across the country have also demonstrated their resolve, as Mary had indicated, and organizational adaptability through their outstanding collaboration with Treasury during and after the worst financial crisis since the Great Depression. The new issue bond program, which Mary alluded to, which allowed for the continued development and rehab of affordable housing through the worst economic downturn in generations, is one of the most successful emergency housing programs that hardly anybody has heard of. When it was launched in 2009, HFAs were struggling to maintain access to the tax-exempt bond market, jeopardizing the ability to fund their programs and initiatives. Treasury and the administration recognized that sustaining the activities of state housing finance agencies and maximizing the use of their local market knowledge and expertise was critical to helping low and moderate income families access mortgage credit as capital markets seized up and tax-exempt markets turned upside down. Despite continued disruption in the tax-exempt markets, thanks to outstanding execution by participating housing finance agencies, by the third quarter of 2011, the new issue bond program had helped finance more than 100,000 single-family homes and more than 24,000 rental homes, the results that compelled Treasury to extend this emergency program through 2012. Now, as we know, since the darkest days of the crisis, we've made tremendous progress. Fewer borrowers are falling behind on their mortgage payments or entering foreclosure. Distressed properties and shadow inventories are also declining. A majority of housing market indicators have reversed their declines. Housing starts and home prices continue to recover. A recent Standard & Poor's Case-Shiller home price index for the 20 largest cities shows that home prices in January increased 8.1% compared with a year ago, the largest year-over-year increase in more than 6 years and the 8th straight month of year-over-year gains. Here in Chicago, home prices have increased more modestly by 3.3% over the last year, notching the 3rd straight month of year-over-year gains. But things are headed in the right direction. Importantly, housing has contributed positively to GDP growth in each of the last 6 quarters, and forecasters expect that it will continue to be a positive force in growth as the housing market continues to recover. Yet, despite this encouraging news, Treasury and the administration have not lost sight of the fact that major challenges remain. Although we've achieved significant progress, many homeowners continue to struggle, particularly in some of the hardest hit communities and regions. We have 5 key issues on our agenda that aim to alleviate the pain of these hardest hit communities and regions and create a more sustainable system of housing finance. First, we must continue helping as many borrowers as possible refinance into affordable mortgages by taking advantage of today's historically low interest rates. Refinancing can save a family up to $3,000 a year on their mortgage payments. the equivalent of a significant middle-class tax cut. So far, more than 15 million borrowers have refinanced, and since its introduction by the GSEs and the administration, the Home Affordable Refinance Program has helped more than 2.2 million underwater homeowners secure a lower-cost mortgage, putting more than $27 billion a year in real savings into the hands of American families and into our economy. The reason why, thank you, it is something that we're proud of, and I will offer a challenge here, because the reason why I mention HARP today is because among the more than 2 million underwater homeowners who are eligible to take advantage of the program but have not yet done so, many of them live right here in the Chicago metropolitan area. Of the 188,000 Illinois homeowners who could save up to $3,000 a year by refinancing through HARP, 165,000 of them, or 88% of the statewide total, live here in the Chicago region. I challenge all of us here today to help as many of these underserved, financially burdened borrowers take advantage of this important housing resource. However, as you know, HARP is limited only to GSE-owned or guaranteed loans. And so we should do more to help the hundreds of thousands of households whose loans are not owned or guaranteed by Fannie Mae or Freddie Mac. We need to help them refinance out of their high-cost mortgages. Approximately 30% of these loans held in non-agency trusts or on bank balance sheets are higher risk, interest-only, or balloon loans that pose a greater risk of default. And as the President has said, whether a household could take advantage of today's historically low interest rates should not be a matter of who owns their mortgage. Fundamentally, this is an issue of fairness, which is why the administration supports legislation that would level the refinancing playing field for all responsible American homeowners. Second, we continue to take actions to address the plight of communities that are still suffering from the aftermaths of the housing crisis. And as Mary mentioned, our Hardest Hit Fund program, which provides financial support to the hardest hit states and the District of Columbia through their respective housing finance agencies to develop locally tailored programs to assist struggling homeowners, is gaining traction. And we will continue working with those states to ensure that their programs reach those in the greatest need. Treasury worked with HFAs to get programs up and running to assist homeowners. We know that asking HFAs to move primarily from finances affordable homes to implementers of foreclosure prevention programs would take work. In many cases, it required the creation of new programs and infrastructure entirely from scratch, and the procurement of new resources and systems where none had previously existed, which understandably took time. But here in Illinois, we've seen IDA use housing hardest hit funds to provide $100 million in assistance to more than 7,100 troubled borrowers, with at least our data over 400 new applications being approved each month. And IDA's geographic reach has been no less impressive, thus confirming the benefits of using housing finance agencies to administer hardest hit funds. Resources that have come through IDA in the hardest hit fund have reached households in 95 of Illinois' 102 counties. And they help these families access unemployment-related mortgage payment support through the hardest hit fund, and that is really an accomplishment. Third, while lending was too fast and too loose in the run-up to the financial crisis, we're now in a situation where many families that can effectively take on mortgage credit obligations are being denied access to credit. In this regard, the Federal Reserve has a similar outlook. Chairman Bernanke noted recently that tighter lending standards are probably preventing creditworthy borrowers from buying homes. which could be slowing the revival in housing and slowing the economic recovery. Moreover, many creditworthy borrowers who are being denied mortgages today had their credit record damaged because of job loss or reduced wages from the financial crisis caused them to miss an auto payment or credit card payments. These potential borrowers still meet Fannie or Freddie and FHA underwriting requirements, but are being underserved by many lenders, barring families who suffered from economic events beyond their control the ability to obtain a mortgage even after their lives and livelihoods have substantially recovered, neither serves their interests nor promotes economic growth or financial stability. Of course, we also recognize that a continuing impediment to expanding credit availability is lingering investor uncertainty, and working to address this issue continues to be an important part of our agenda. As you know, the Consumer Financial Protection Bureau, along with other regulators, have released a collection of mortgage-related rules in the past months that cover different parts of the mortgage origination chain. These include requiring lenders to verify a borrower's ability to repay, setting best practice servicing standards, increasing transparency for appraisals, setting standards around originator compensation practices, establishing escrow requirements, and mandating the provision of disclosures, such as those relating to counseling for high-cost loan borrowers. These standards will help homeowners obtain mortgages with straightforward terms and obligations both lenders and borrowers can clearly understand, providing for a more sustainable mortgage finance system going forward. While investors, securitizers, originators, and servicers may not agree with every aspect of each of these new rules, their release helps provide clarity to market participants who may have been waiting for greater certainty before putting their capital back to work. With the release of these final regulations, the rules of the road going forward are beginning to take shape. Market participants can once again plan to go about the business of taking on mortgage credit risk and serving a much broader swath of the market that has been the case since the onset of the financial crisis. Fourth, despite severe fiscal constraints, the President proposes to make significant strategic new investments in affordable housing because of its importance to families, communities, and the economy. These investments include making permanent and nearly doubling funding for Treasury's New Market Tax Credit program, securing $1 billion a year in permanent funding for the National Housing Trust Fund to build, preserve, and rehabilitate affordable rental homes for extremely low-income households. The administration's fiscal year 2014 budget also recognizes the foundational role played by the low-income housing tax credit by including several improvements and refinements to this vital Treasury-overseen affordable housing resource. The proposal would, among other things, let states increase their effective tax credit allocation caps by up to 19% by converting a portion of their private activity bond cap to tax credits. It would also add preservation of federally assisted housing to the current list of selection criteria for states to consider in their annual allocation plans. They would let sponsors of tax credit housing adopt an income averaging plan to promote mixed income housing and broaden investor demand and competition for tax credits by allowing real estate investment trusts to pass the credit through to their shareholders. And again this year, the administration proposes to authorize Ginnie Mae to securitize multifamily loans originated under the very successful FHA Housing Finance Agency risk-sharing program. Some experts predict that the Ginnie Mae full faith and credit guarantee would reduce mortgage interest rates by as much as 200 basis points, which would translate into lower rents and potential rent subsidy savings for federally assisted apartments. And as many of you know, the inclusion of this provision in the President's budget is in no small part due to the efforts of Mary Kenney, who has eloquently made the case for the program in front of Congress on behalf of the National Council of State Housing Agencies. Finally, the administration proposes to replace the temporary Build America Bond Program with a new permanent bond program called America Fast Forward Bonds. Critically, this program would provide housing finance agencies an alternative funding source to the issuance of tax-exempt bonds. Like Build America bonds, America Fast Forward bonds would be taxable bonds issued by state and local governments, including housing finance agencies, on which the Treasury Department would make direct payments to the issuers in an amount equal to 28% of the bond's coupon interest. In closing, I'd like to discuss the fifth housing issue on our agenda, our ideas behind long-term housing finance reform. Today, as you know, nearly 9 out of 10 mortgages are still supported in some form by the American taxpayer, a situation that is both undesirable and unsustainable. The real challenge, however, is effectively revamping the system without severely disrupting the mortgage market and the ability of American families to access credit, a task made all the more delicate in the midst of a recovering housing market. While we are still exploring which paths will lead us towards the safest, most vibrant system of housing finance, we do know that a set of core principles will guide us along the way. No matter what path we take to reform, Treasury and the administration have core fundamental requirements that must be met. We support a system in which private capital is the primary source of mortgage credit, that bears the primary burden for credit losses, and strongly protects taxpayers. As Secretary Lewis stated, we can't ever again be in a place where American taxpayers are left responsible for mortgage financing practices that get out of control. We also seek a system which provides American families access to sustainable mortgage credit, which must include long-term fixed-rate mortgages, and which provides for credit availability under all conditions, even during times of severe market stress. Any plan for housing finance reform must also meet the needs of our nation's growing population of renters, promote the availability of sustainable mortgage credit in all communities, and serve borrowers across the income spectrum. Comprehensive housing finance reform is not just about achieving any one of these priorities. It is about developing a system that achieves all of these priorities. Given these core principles, it's clear that no matter what path we take, housing finance agencies should have a paramount role to play. IDA and their counterparts across the country have proven too strong, too important, too resilient, and too creative not to be counted upon as strong partners in the future of our housing finance system, especially with respect to helping address the nation's affordable housing needs. Thank you very much. Thank you. If you have time. If there's time.
I think you all can see what a strong advocate and good friend we have in Dr. Stegman, and it is truly a blessing to have him in Washington advocating on behalf of all of the needs of our communities. Dr. Stegman has graciously agreed to take a couple of questions if anyone has some questions.
If you could address the FHA role in the system, both single and multifamily. I understand in the president's budget, for the first time, the single-family fund had to request some coverage because of the fact that it covered for the system during the crisis and provided liquidity when others wouldn't. And, but I believe the multifamily fund has a healthier situation. I don't know if you have to track that from your seat, but could you address the role of the FHA in the system, both
Sure.
single and multi?
Thank you for that question. We actually don't know for sure whether and to what extent FHA will tap its indefinite line of credit from Treasury until the end of the fiscal year. And with the implementation of a number of policy changes, the revenue coming in from new books of business, it's really unclear. The budget that showed a possible shortage in the reserves of $943 million may well be different at the end of the fiscal year. Those losses are primarily after Fannie Mae and Freddie Mac failed and were taken into conservatorship, when it was FHA that, as you say, stood up and provided enormous liquidity to the market and to families to buy homes. Those losses are for those books of business, and the succeeding books of business are very healthy. And so, number one, we think that FHA is a vital resource for affordable housing to families both today and in the future. FHA reform is part of our larger vision of housing finance reform. It continues, you're absolutely right, it does continue to play a significant role in multifamily housing, and we expect it to continue. The risk-sharing partnerships, again, with housing finance agencies and HFAs is really important.
Hi, I have a question on Basel III. You know, now we have kind of a stay of execution, as I kind of call it, in terms of the implementation of the rules on Basel III through Dodd-Frank. But I'm just wondering, like, what are the discussions that you guys are having in terms of the community banks and their possible exemption on having to follow those rules, and kind of where is the discussion at while we're kind of in this time of in a holding pattern with Basel III?
Let me say that the capital rules, as you know, are issued by the Federal Reserve. Treasury has relationships across all of the independent federal regulators, but these rules are really under the domain of each of the regulators. The issue about either exemption or the effects of capital rules, and it's not just the risk-based weights, it's a number of other things that potentially could affect community banks. This issue is under discussion, and we meet all the time with community banks, independent bankers of all kinds, and their concerns are clearly being heard, and discussions are being, the rulemaking continues, and I really can't say more about that other than the issues that you care about on the qualified residential mortgage, on a variety of the rules. We hear, and we see the public comments, we understand the concerns, and are trying to work through those.
Thank you so much, Dr. Stegman.
Thank you.